Good morning, ladies and gentlemen. How do you do? I'm your host, Seth Julian. We're going to take a look and welcome, of course, today's morning coffee briefing. Excuse me. We're going to take a look at what some of the effects may be, or see if we can discern some of the effects of yesterday's 0.75% interest rate rise by the U.S. Central Bank, which, by the way, was met with a 0.5% interest rate rise with the Swiss National Bank today. We expect this to be a trend that continues. If, unlike the U.S., they're behind the curve and trying to catch up, in other places like Switzerland, where they had no real inflation, they want to get ahead of the curve because bubbles were developing in the asset markets. So let's take a look at what this really means. First of all, strictly speaking, it just means that the cost of money is going up. Money had been, for the last, let's call it, 15 years, since the 2007 great financial crash, been essentially free. That's no longer the case because inflation has picked up. In order to keep price levels from rising uncontrollably, the central tool that that monetary policy uses is to raise the cost of money. Now, that reflects best here and in the U.S. dollar index. This is not those previous graphs were graphs of stock indices. This is a graph of the strength of the U.S. dollar weighted against six other. Won't go into it. It's a graph of the strength of the U.S. dollar, and you see it's rising and likely to continue to rise. As the U.S. dollar strengthens, money is going to flow. As the U.S. interest rate rises, rather, money is going to flow from other currencies into the U.S. dollar simply by virtue of what's referred to as the carry trade. And that simply means you put your money into a dollar-based account, earn the interest that's paid on that, and do nothing. You don't have to listen to your broker. You don't have to make decisions. You don't have to really trade. You just sit there and collect that money. And if it's greater than the inflation rate that is in the country, if it's greater than the interest rate you're making at your home country, you do that. Well, many do. Now, this is really what I want to point out to. These are the major indices of the world. This is the CAC 40. This is the NASDAQ. This is the Nikkei. Again, this is not a stock index, but the rest of these stock indices are not doing so well. And that's because we are, including the Tadawul, the usual bellwether of outperformance. But, here's the US 5, and this is the S&P. Now, what I'm pointing to is this, and I don't even really have to expand these. There was a momentary blip last night, I guess, whenever it was, or certainly this morning, the charts are reading positively on the stock markets from a very limited window. We're in a recession. There's no, and while the interest rate moves by the federal bank are welcomed by most traders as being good for the economy, in the long run, in the short run, they're going to weaken stocks. Stocks are going to weaken, and they're going to continue to weaken. They've been weakening since the beginning of the year, as the COVID wrests more damage out of the Chinese economy, as inflation slows things down. The stock markets are going to continue to decline, regardless of any temporary blip upwards we may see as a result of this interest rate thing. The interest rate rise generally foretells recession, and I don't believe it foretells it. We're in a recession. Don't need to foretell anything. We're in a recession, and we're trying to wring the inflation out of the economy. We will do that. The question is when, how long, soft, hard landing, all those nonsensical commentary at terms. But the bottom line is this. Interest rates are rising. Asset prices are going to fall, including the stock markets, which we're looking here. They're not going to reverse anytime soon, in our opinion, and therefore they're good trading opportunities. So, ladies and gentlemen, I'm your host, Seth Julian, wishing you all the ability to trade with confidence. Bye-bye for now.